We know from data from the Financial Conduct Authority, the regulator, that between 70 to 80% of retail traders lose money. 70 to 80%. If you want evidence of that, go onto any FCA regulated broker's homepage and they have to, by law at the top, write how many of their clients lose money. What percentage? 70 to 80% lose money. This is then verified, audited by the FCA. So we can assume they're not lying and underestimating the numbers unless you're some conspiracy theorist. Okay, so 20% are making money. Let's first look at how people are losing money. As you can imagine, roughly on those figures I just gave you, there are 4 different ways in which traders are losing money and one in which, if they get it right, and usually they stumble across it, they're making money. So let's look at the losing ways first. Usually they've got a price point like this at 100, they set some target at 200, some stop loss at 80. Well, if you do 100 trades like that, just even do it hypothetically, monitoring the markets, do that experiment without risking real capital, that's what will happen. Then you have the nervous trader who says, oh, no, the targets were all too far away, I'll put them closer. Does that still makes you lose money? Maybe a little bit less, but you're still losing money. So then they think, get rid of the stop loss, don't need it. All that happens there is they end up having a lot of trades which are then kept open for long periods of time, and it just sucks up their capital. They run out of capital sooner or later because they don't get enough YOLO to the moon trades. Some idiot in the comment is going to write a particular crypto, and then they're going to say to the moon. I can't believe they let cell phones into such mental asylums, but there you go. And then you've got the scalper who says, well, I'll turn it on its head, Alpesh. And of course, they win a lot, but their losses are far bigger than their wins. And they'll talk about their winning trades because they'll just put into the drawer the open positions, which they don't count. They don't mark to market. So that begs the question, well, what's the winning way in which people do this? Well, on the winning side, what the trader is more likely to do is, yes, they will indeed have a stop loss, but it'll be a volatility-based stop loss. The more volatile the market, further away the stop loss. But then again, more volatile the market and further away the stop loss, then they'll have volatility-based position sizing, a smaller position size. That way, they're not risking lots more money just because the market's more volatile and their stop loss is commensurate to that. But what about the target? There won't necessarily be a target. First of all, they will not add to losing positions, so losers add to losers, but their winning upside will be they'll add to the winning position once they've got profits, and they'll put a stop loss at the entry point when they do that. So they're not necessarily looking at a target. But what will give them the edge? Well, a coin is right 50-50. The edge they're looking for will often be as little as 1% more, and it'll often be momentum driven. There's more links in the bio to go into more detail of this and what hedge funds do as well.